Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here on the Smart Investing Show. Got a lot of things to talk about, and a special show today. October 16th is the last day for filing your taxes for 2022. I have a special guest today, Tracy Gaines, who, gosh, we were talking earlier in the show. I've known Tracy for 20 years. Maybe longer. We've been actually doing my taxes for that long. He's got some great topics we're going to talk about to make sure you understand what's going on tax-wise. Also, too, got some things I want to talk about. I've got to talk about that CPI that came out on Thursday because we had a great jobs report the previous Friday, or a week ago Friday. But I was disappointed by the Consumer Price Index, as I believe there would be a slower growth in the inflation rate. Well, with that being said, I don't believe the report is problematic. The headline number for September of 3.7% matched August rate, was only slightly ahead of the expectation of 3.6%. The core rate, which excludes food and energy, came in at 4.1%, which was pretty much right in line with expectations and was below August readings of 4.3%. That was also the lowest reading on core CPI since September 2021, when the report showed inflation of 4%. Now, regarding the miss on the headline number, it is important to remember that with the recent increase in energy prices, we have lost a major benefit that was pushing the headline number lower for most of the year. In fact, energy prices only fell 0.5% compared to last year, and gasoline prices were actually up 3%. This compares to just a few months ago in the month of June, when energy prices were down 16.7%, and gasoline prices, well, they were down 26.5% compared to the prior year. These declines are extremely helpful for the headline number CPI. One area that remains surprisingly high is the shelter index, as it has climbed 7.2% compared to last year. I have pointed out many times that this is a lagging indicator, but I'm surprised to see how much it is still weighing on the overall inflation front, as housing rent prices have cooled tremendously on a real-time basis. With that said, the shelter index accounted for over 70% of the total increase of the core CPI. I still believe the shelter index is likely to cool as we end the year, which would be beneficial to both headline and core CPI. And it's funny, I came up with a formula that they use to get this headline number for shelter. And it is so complex, and the formulas are just unbelievable. Chase and I were talking, is there some way to come up with something different? There doesn't appear to be, but the number is just really hurting the CPI because of the way it's calculated and is lagging. We know that rents are coming down. There's so much inventory out there for rents and for the housing market slowing down. We saw this past week builders are starting to have some problems. So housing is not quite what you may think it would be, but accounting for about 70% of the total increase in CPI, well, that is a problem. So inflation's not as bad as the CPI number is. We'll be looking forward to the PCE number, which is what the Fed really uses. But I was disappointed with the CPI number that came out. I thought it would be better, and that did cause some turmoil with the markets. And that brings me to stock market volatility. I want to address that before we get to Tracy here. You may be wondering why there is so much volatility in the markets lately, and I will tell you it's because there is too much information. I've been managing money for over 40 years, and I remember back when Alan Greenspan was a Federal Reserve chairman. He was the only member of the Fed who could speak. He also did not speak very often. It was funny back then. He spoke so little that financial commentators on TV like CNBC, which was one of the few at the time, would make decisions based on the size of his briefcase on what decisions he may make. The FOMC consists of 7 members of the Board of Governors, and there are 12 regional Federal Reserve Bank presidents. It seems to me that many more of these governors and Federal Reserve presidents are speaking publicly on their thoughts. I do agree that we need information, but not the opinions of so many different people who can change their mind when they meet and make decisions on interest rates and policies. I know it will not change, but I think too many people giving their views on what they think will happen is doing nothing more than causing volatility and confusing you, the investor. In the end, it doesn't matter what they say. It is only important what they decide when they meet 8 times a year. Everything else, well, that's just a bunch of noise. And it's made investing very difficult because we've seen some volatility we've not seen before. It scares investors, and we always talk about how you got to focus on the fundamentals. Don't worry about the short-term movements. Don't worry about what this Fed governor said. Look at the business you have. What is going on? Are they making sales? Are they having profits? Are they reducing their debt? That's what you have to look at when it comes to investing. So I had a couple of topics. And if you want to get these topics, these do come from our newsletter. It's a free newsletter. Just go to our website, smartinvesting2000.com. That's smartinvesting2000.com, and just go right to the middle page. You'll see newsletter, sign up for it there, and you'll get these topics. We have many other ones, which I might have some time today to talk about. But we did talk in the newsletter that went out on Friday was offshore drilling, more on stocks. Are they expensive, not expensive? The National Labor Relations Board, global trade, many important topics to help make you a smarter investor. So again, go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And usually we do have Harrison Johnson, our CFP, our financial planner, comes on the show about, half past or so. And he's getting married today. So he will not be calling in today to give financial advice. He will be getting married today, probably just about that time frame. And Chase is the best man, so he's up there as well. But I'm very happy to introduce, you may have heard of him before, Tracy Gaines, who is president of Gaines and Wells Financial Services. Tracy, thanks for being here this morning. I appreciate it.
Hey, Brent, thanks for having me on. I appreciate it. It's been a long time since I've been in these seats, so it's good to partner up with you today, and congratulations to Harrison.
Yes, yeah. I mean,
he's a good guy. I like him.
Yeah, he's a good guy, great financial planner. And now I think, I was going to say everybody in our office is married, but no, we still have a couple that are still single. So
well, let's get working on that.
Yeah, I know. Well, that's not my job. You get in trouble doing stuff like that nowadays.
Good.
But I asked you, I think it was like last week, Tracy, can you come in and we want to talk about what's going on in taxes? You came up with some great topics, and I really want to address these. Is it okay if we open the phone lines for listeners to call in?
Absolutely. I've had people call in. And
okay.
It is the tax deadline, as you know, Brent, and you mentioned earlier, on Monday, October the 16th. And this year for us in California was a very unusual year. Normally everybody knows that we have our tax deadline is April 15th, 16th, right around that every year. But because of the heavy rains and the floods and everything that was going on throughout the state, the Internal Revenue Service decided to extend in most counties in California and a couple other states the filing deadline until October 16th, which is coming up, of course, on Monday. So the really important thing about that is April 15th is a very important day, not only to file your returns, but the main thing is to pay the tax.
Right.
We can file extensions, but that's only an extension on time to file the paperwork, to file the tax forms, not to pay the tax. Well, that got extended along with an extension to file the paperwork. So if you haven't paid your 22 taxes yet and you're behind, normally you'd be facing some pretty stiff penalties at this point in time, this far down the road, 6 months after the filing deadline. But they've extended that also. So again, at the last minute, if you can't get your return done and you know you're going to owe, on Monday, get that money into them, make a payment, throw some money at them. Because the biggest penalty starts off, which is the late filing penalty, and that's 5% per month, up to a maximum of 25%. So
that's a huge penalty.
That's a heavy hit. Yeah, so if you owe
$3,000,
that can get out of hand pretty quickly. So.
And Tracy, if you don't pay that tax you owe on October 16th, the clock starts then. It doesn't go all the way back to April, does it?
No, it starts on October 16th.
Okay,
yeah.
October 16th.
So everything was extended,
right,
to that deadline. But again, this is unusual. So it was kind of funny because people took advantage of it. We had a lot of procrastinators.
Oh, yeah.
Man, I got 6 months. I don't have to mess with this. So we're dealing with that right now. But next year, barring any other catastrophe, the filing deadline will be back to April 15th. So get in early, get your stuff done, get your taxes paid on time. And our job at Gaines & Welsh is we've been in the same location doing taxes for people for over 46 years now. And so our main mission in working with our clients, Brent, on taxes is so that you don't pay one dime more than you're legally obligated to the federal or state government. So one of those things where people don't pay attention, don't get their taxes on time, these penalties can really add up. So maybe make a New Year's resolution, get in to see your tax guy if you need help. We're always available for everybody starting in the new year. But get those taxes paid on time so you're not giving them any more money than you absolutely have to.
And actually, I've been using you for, again, I think like 20 years. Been doing my taxes. We also refer our clients to you as well. You work with a many number of our clients as well. They've been very happy with you. So again, and your website, or do you have a website or email? Let's see. What are you?
It's Gaines and Welsh. Gaines and Welsh. .com, I think, or Gaines and Welsh Financial Services.com. Yeah. Just Google Gaines and Welsh and you'll find me. Like I said, I've been in the same location down in Mission Valley since 1977.
And Welsh is spelled
W-E-L-S-H.
Yes, I want to make sure I get that right. Because sometimes people can't get Welsh spelled right. You just
I know. Well, I say Welsh, people type in Walsh. And
yes. So W-E-L-S-H. Tracy Gaines. And and actually email you, Tracy@GainesandWelsh.com. So that's great. So, and one thing too, and you did bring it up, is people have to realize that this is a one-time thing. Because people get confused, and then they think, oh, well, last year, 2023, I could do it. Don't do this in 2024.
I'm trying to warn you. Again, barring a catastrophe, this is a one-time special event, which really did help people. Not so much in San Diego, but other parts of the state were really wiped out with floods and things. And in the past, like wildfires, we had wildfires, obviously, in the early 2000s, and we got extended time because, again, it impacted people's businesses. It impacted, obviously, their personal lives. And so the government has been pretty good about giving us extra time when we have to deal with unforeseen events. Give us time to balance up and get our taxes done. And so again, you're right. This is a one-time deal. That's why I'm saying get in early, get your stuff done, and don't run up against that April 15th deadline.
Yeah, and don't think it's going to happen again next year because it won't.
No, let's hope not.
So all right. I also want to open the phone lines for you as well, and we got some great questions I want to ask you here. But if you have a question for Tracy, he said he will take phone calls. 833-288-0973. That's 833-288-0973. And you got a tax question, you asked Tracy about that, and we'll go with that. So many great topics here that I want to get in before the show. It's going to go very quickly here. Let's talk about the rules regarding the sale of a personal residence. I was doing something this past week. In 2021, California lost 300 people a day. Just went to Texas. So, I mean, people are selling their houses and moving to other states. How is that going to affect them? What should they be doing?
Well, this is, again, this law has been in place going back to 1986. They changed the sale of personal residence rule. So it's not a new rule, but it's really interesting how people have certain memories about things. Most people don't know a lot about taxes, and they understand they don't. But one is about the personal residence. And I will get calls all the times when, you have clients refer in or have other clients refer their clients in. And so I know when I sell my personal residence, how long do I have to reinvest to buy another home? And that's not the rule anyway. That's been gone for decades. I don't know where people come up with that. But the current law on the sale of your personal residence, you have to meet some rules, of course, in order to qualify for getting the tax benefit for the sale of your personal residence. The couple key ones is, number one, you have to have owned and lived in the home for 2 out of the 5 prior years as of the date of sale. And those 2 years don't have to be consecutive. You could have lived in it for a year, moved out, rented it out, or let it stay vacant, then moved in. And as long as those 24 months are within the final 60 months, then that time element, you qualify for the sale of personal residence capital gain exclusion. The other thing is living in the home. You also have to have lived in the home as your personal residence. So this sometimes can be a question when you have a couple that get married. One spouse owned the house, the other spouse, they got married, moved in, and let's say the second spouse only lived in there for 1 year out of the 2 years. Well, you only have to have one person qualify for the lived-in rule, all right? So if your spouse lived there as a personal residence but didn't live there the full 2 years, you're fine as long as one of you did.
One of you did, so it's not both.
And the other thing is you can only claim this personal residence capital gain exclusion once every 24 calendar months. So the date again would be the close of sale on the personal residence, and you buy another property or you move into another property, wait another 24 months, and then you can claim it again. And you can do that every 24 months. So what was interesting, kind of in the same area, kind of go on a tangent here a little bit,
Sure.
is when the rule originally came out, people are pretty smart, and that's
Right.
what we do is say, hey, we got this, we found this loophole in the law.
That you can do. I
And
think I know where
everybody
you're
loves
going, but
loopholes.
go ahead. Yeah,
It is awesome. So, people that had multiple rental properties, they had 3, 4, 5 rental properties, and so we're talking about, said, this is great.
Yeah.
Sell your personal residence, get your married couple, $500,000 capital gain exclusion, which is fantastic. Single people, $250,000.
Right.
I'll sell it. I'll move into my rental property, wait 24 months and sell that, and then just liquidate all my rental properties and get a $500,000 capital gain exclusion.
That's great. That's great.
That was great
tax
planning.
Great
Well,
tax planning,
finally,
yes.
the IRS got a hold of us.
What?
No, I don't think we intended that.
I didn't know.
So, yeah, that's not the rule anymore. So
So you can't do that any longer.
well, it's limited on the capital gain exclusion that you get. So if you rented a property, then you move in it and you want to sell it, it's a very complicated calculation. But the basics of it is that you take a look at the entire ownership period.
Okay.
Okay, so let's say I owned it 10 years. When I sold it, I rented it for 8. I lived in it for 2. During the entire ownership, it was your principal residence for 20% of the time. So we would get
wow.
20% of the exclusion.
Wow. Because
So-
I know some of our clients that they've had homes that they've had for 20, 30 years, and they say, well, I'm done renting. I don't want to rent any longer.
I'll move into it.
I'll move into
I'll
it.
play the game.
Play the game.
No.
Yeah, they're going to get about
gonna work.
5% of what they're
Yeah,
going to get
whatever
after
the
30
percentage
years.
works out to
Wow.
be. So, but it's only from 2009. I think that's about the date you go back to because that's about when they changed the law.
So when you say only to 2009.
So what happened prior to that doesn't count.
Okay.
All right. So I think it's around August 2009. I don't have it here in front of me, but yeah, if you were renting it in 1988, anything prior to the 2009 date doesn't
Right.
matter, but you go from that point forward. So it's a limited exclusion, again, based on the facts and circumstances.
It still save you
claim.
quite a bit in taxes.
I'll tell you, it's one of the best tax law changes that came into effect. The prior law for that helped a little bit.
The
but it was-
rollover where you can roll
yes,
over,
where you
right.
had to buy up and
Right.
you had to be over 55, and
Right.
and so that was beneficial. But $500,000 capital gain is a huge benefit.
Right.
And again, if you get to parts of the country where real estate prices aren't as high as they are here, it pretty much wipes out the capital gain tax for single people and married couple in other parts of the country where the sale price of their home is $400,000, which is good money
Right.
in other parts of the country. But you have a $500,000 capital gain exclusion. Basically, most people won't pay a capital gains tax in the lower valued real estate areas across the country.
Right. In California, San Diego is unique because there's a lot of capital gains, especially now, the
Yep.
big run up over the last few years. But the other thing, too, is that unfortunately, nowadays, a lot of people are getting married, getting divorced. How does that happen when somebody gets divorced? One person keeps the home. Who gets the exclusion? I mean, how does that work? Does that throw things in?
Yeah, that really
Is it?
depends, again, on the divorce settlement itself.
So it's actually going to be in
So-
the divorce decree. What
Yeah,
who
well,
gets what?
again, you talk about when you go through a divorce, there's the property settlement portion. I think that kind of leads into another question that I was going to touch on, but this is a good point, I think, is most of the time when people are going through divorces and the attorneys are busy, trying to do what they need to do for their clients, what I've seen in my 40-plus years is that most of the time there's not a lot of emphasis put on tax planning. And what I mean there is assets have different tax bases. And
Right.
some assets may have a capital gain. Other assets might have zero taxes to pay.
Right.
And so, for example, let's say someone's going through a divorce and they have a rental property that has a $500,000 capital gain in it or profit equity, and then there's a personal residence that has $500,000 equity. So if it doesn't matter who has what property would you want? I want the personal residence.
Right.
Because I'm going to get a capital gain exclusion.
Right.
I'll give my spouse the rental property.
Right.
But when you sell that, you got to pay the capital gains.
Capital
tax.
gains on it,
So
right.
it's the same thing to take a look at. Maybe you're splitting up stocks and bonds, and you're taking a look, and we've got some legacy stocks that we've held for many, many years.
Right.
Low tax basis, a lot of capital gain. We have the other half of the portfolio that has been purchased somewhat recently, has a lot smaller capital gain. So with some tax planning, you want to separate out the stock portfolio. You might want the ones that have a very high basis and be willing to give up the stocks with low basis. Just simple things like that. A lot of times things aren't addressed from a tax planning perspective because there's so much going on when you go through a divorce.
And actually, when people go through divorce, I mean, I don't think, and maybe I'm wrong, I don't think I did it when I got divorced. I don't think I called you to say, well, what should I do tax-wise? I don't. People probably should, especially on the house and stuff like that. There's so many things that they can trip up on.
Right.
They should have called you in addition to the other stuff. And you are pretty, you got kids, you got all this stuff going on. But it wouldn't hurt to give you or tax person a call during the divorce saying, well, how is this going to happen?
Yeah, tax planning is key.
Yeah.
When you go through the property settlement portion and you're trying to divide up, who gets what and how it all goes. So.
Yeah. So, well, let's also talk about, and by the way, phone number is 833-288-0973. That's 833-288-0973. Got a tax question. Tracy's here today, can answer your tax questions. I want to talk about, obviously, we're an investment management firm. Talk about the treatment of the sale of company stock options. We see this every once in a while. It comes in, and it really is another thing that people get tripped up on. What should they be doing here?
Again, this is a very complex area of the tax law, and if you have stock options and you're getting just a few $1,000s, it's not that big of a deal. And I'm just going to be talking in general because each company's plan is going to be different,
right,
based upon how they set it up. Excuse me. And so you have to take a look at the plan and how it affects people. The main thing I want to bring to people's attention here is when you finally exercise your stocks, and if you're going to acquire the stock and not sell it. A lot of stock options, once they exercise them, it's a same-day cashless transaction. You buy them, you turn around and sell them same day. It's ordinary income. It goes through your W-2. They withhold the taxes, and that's a pretty smooth way. Where it gets more complicated is when you want to hold that stock. I think the company stock value is going to go up. I have confidence in it. If once I buy it and exercise and buy the stock, if I hold it a year and a day, right, I get long-term capital gain treatment. So we want to take a look at that. So what's built in that, and again, we're talking about larger stock option packages, is
not larger and being dollar amount. What would you say larger?
I would say probably six digits in the $100,000 or more. It can be a little bit less, but when I get to, I'll explain a little bit more detail how the amount is going to impact whether this could trip you up or not.
Trying to have people understand, well, does this concern me? Should I be worried about this?
Like I said, if it's a $10,000 stock option, probably not a problem. But
you don't think
get into
$50,000,
$60,000, $80,000, $100,000, you need to be aware of what I'm about to tell people. So I'm sorry.
You might have that cold. There's a cold or something going around. A lot of people
morning on my throat. Got something going on there. So what I'm referring to is I exercise my stock, I buy it, and I want to hold it. And so people think, that's great. I've got nothing to worry about. I just tell my tax guy I bought them, but I didn't sell them. Well, you need to still let your tax accountant know of the transaction. You can't ignore it. And so what happens, Brent, is when you get the stock at the exercise price, the difference between the exercise price and the fair market value on the date of the transaction can produce quite a big gain in of itself.
Right.
That's the gain that is being deferred until you sell the stock under the regular tax calculation. There's a tax out there that's been around since the 60s called the alternative minimum tax. And so this law was originally put in place to really tax the very, very wealthy people in the country that were not paying any taxes at all. And so they said, okay, everybody's got to pay a minimum amount. So they minimize some of the deductions that you normally get in order to create this alternative minimum tax. So we're always calculating your taxes two ways. One, under the regular method. The second way, under this alternative minimum tax method. And so what happens in this particular situation is while the profit on the acquisition of the stock is not subject to regular tax, that bargain element, that built-in gain that you haven't recognized, That's alternative minimum taxable income. So now you can see why I'm saying it depends upon the dollar amount. So let's say you exercise some stock. My cost is $10,000, but the fair market value is $110,000.
Right.
I have $100,000 of alternative minimum taxable income.
So that's where people
and
trip
that
up on.
needs to be
Right.
put into the return.
Right.
And in certain cases, you will have an alternative minimum tax on that $100,000 of profit you haven't recognized for regular tax purposes, but it is income for alternative minimum tax. So kind of an example, this really reared its ugly head back right around 2000 when Qualcomm here in town, remember Qualcomm stock,
Yeah.
you had secretaries that had been working there, and then all of a sudden there were $4 million and it was fantastic for everybody. I was so happy for everybody that made out on that. But there was a couple cases revolving around that illustrates my point. So people had the company stock, they exercised it, they own this stock, they've got $1 million profit in the stock, and so they say, well, I'm going to hold on to this because Qualcomm is just going to keep going, and so they didn't report it to their tax accountant because I didn't sell it.
Right.
So you don't need to know about it. So what happened then is a year or two after that, they got a letter from the IRS saying, you owe a bunch of taxes. And they go, I didn't sell it.
Right.
Well, the problem is they didn't calculate the alternative minimum tax. Now, the AMT was reconfigured back in 2018. Originally, it was structured to really only tax, a handful of big families.
Right.
But they never, they never exactly. They never adjusted it for inflation since the 1960s. Right. So, I mean, you were in it for a time. I was in it. Higher income people were paying this alternative minimum tax. So what happened in the 2000s is you had this bargain element, and nobody thought about the alternative minimum tax. So when she got it, it was worth $1 million. She gets this IRS notice that Qualcomm in the dot-com bubble dropped down to maybe out of $1 million, now is down to $200,000, and they get a tax bill for $400,000.
Ooh, that's not
so
good.
Yeah, there were some really bad stories, and they tried to fight in court, and of course they lost. So the main point is if you have company stock options, if you're not buying and selling in the same year, okay, and exercising those options, if you're going to hold it long term, get with your tax person. And again, depending upon the size of the gain we're looking at, you at least want to do a tax estimated workup and see if alternative minimum tax is going to jump up and cause you any problems.
And this is why, Tracy, I mean, for years, I do it. I always tell people to do it. When something I see in my own personal financial situation is changing, I call you and I ask you, what is this? How's this going to affect me? Can I deduct this? Can I do that? Sometimes you say yes, sometimes no. But to not call when you have a major change in a financial situation, your tax person is foolish because things like you just talked about with these secretaries, they had to pay more. I don't know what they did. They had to borrow the money.
They had to pay it. They had to pay it.
And you can avoid a lot of this saying, hey, I just got all these stock options. Is it going to affect me tax-wise? What should I do? And you can kind of lay out for them, well, if you do this, this will happen. If you do that, this will happen.
Planning is the key.
Yeah.
Financial planning in your business with Harrison and planning, you help people plan for retirement or their other financial objectives that they would want you to help them with. And the same way in the tax field. And another big conception out there, I think, Brent, about tax accountants is that all we do is put numbers on paper. Your job is so easy.
And there are ones that do that, I will say.
Well, absolutely. But a lot of us, professionals, like I said, I'm an enrolled agent.
Right.
And so enrolled agents and CPAs that specialize in taxation, we're really good at our job.
Yeah.
And our job is to know the tax law.
Right.
Again, our mission for our clients is to not pay one more dime in taxes than you're legally required. And so we use tax law because we have deductions and income that might be able to be moved around to 2 or 3 different places in the return that will get us different results.
Right.
And you can't assume, hey, if I do it this way, this is the best. Assume is going to get you in a lot of trouble. There's an acronym we can say for that I won't mention. But the bottom line is you've got to do the work, you've got to do the planning, and you got to take a look at all options in order to get the best results. So planning is key. We love to help people with that. So, again, if you're ever interested in having some tax information or your situation reviewed. I can't do it right now, but probably after the middle of November, if you'd like to call in. Just Google us on the internet, Gaines and Welsh. Like I said, been in the same location in Mission Valley since 1977. You know where to find us, so give us a call.
And what's the best phone number to call you at, Tracy?
619-282-8290. 282-8290.
Area code 619. That's the old.
That's
that
it. 619, baby.
That's the old one, I think, from San Diego. Wasn't
Yeah,
it?
it is.
Yeah, so.
619 and 714 used to be down here, too.
Right. Well, I think we got a call from a stock investor, Dwayne in San Diego. Wants to talk about Ford. Let's go out to Dwayne in San Diego. Dwayne, you're on the Smart Invest Show. Brent Chase, how can we help you?
Hey, thanks for taking my call.
Sure.
I currently hold Ford. I've had it for a couple of years. It's done well for me. I'm just kind of curious, do I continue to hold it, sell it, symbol F? I would like to get your thoughts.
Well, there's obviously the strikes going on, which is something you got to talk about. But we always want to look at the fundamentals to see, with that, is it worth holding on to Ford with the fundamentals? Let's take a look at the numbers here for you. Company Ford has a symbol of F. They are the auto manufacturers. Look at the float on the short, not very much, 4%, so that's good. Institutional owned is about 56%. PE ratio, very good, 11.5 versus 27. That's a positive. Price to sales, 0.3 versus 0.8. Price to book value, 1.1 versus 5.3. And price to cash flow, 3.7 versus 8.7. So right now, you're not paying very much for any of the valuations for Ford, so that's a good start. Unfortunately, we do see earnings down 54% over the past year. The industry is up 3%. I'd want to know why Ford's earnings are down so much when the rest of the industry is not. Sales for Ford over the last year are up 11.9%. The industry is up 18.4%, so not quite as good there. Not happy to see the 5-year estimated growth from the analysts. For Ford, it's a negative 1.8%. The industry is at a positive 9.1%. Now, you do get a nice dividend from Ford. It's a 5.1%. They only use about 58% of their earnings to pay it out, so that's a pretty safe dividend there. Very important for an auto manufacturer is their balance sheet. And they have a current ratio of 1.2 versus 1.5. That's okay. Debt to equity is high. It's 3.3 versus 0.5. Now, keep in mind, when you have an automobile manufacturer, that they do finance the cars. So you really got to dig many times deep into the 10Q to find out, well, what is financing and what is the actual debt of Ford? Because you don't want to have a high debt company. You got to find that out before you stay with Ford there. We do see a net profit margin 2.4%, about half the industry at 5.8%. Not happy to see that. Return on equity is 9.5 versus 14.9. That's not very good. Looking at where Ford has been, I mean, their current price on Friday, they closed at $11.81. Now, their high has been $15.42. The low has been $10.90, so they're getting close to that low, I believe, a lot because of the situation with the union strike here. We do see going out to December 2024, they have earnings of $1.86. That's very important because you go back 90 days, it was still $1.71, so it is up even with a strike going on. So I'm not sure if the analysts, and there's about 19 of them, are they feeling that the strike is going to end soon? What are they seeing? The high was last week, or actually 30 days ago, was $1.89, but still $1.86 is still better than 90 days ago. So the strike does not appear to be having a major impact on the earnings going forward. If I put a multiple of 16.6 on that $1.86, we get a target sell price of $30.86. So it's a positive. As I said, the only thing I'd want to find out is what is their debt situation and why did their earnings fall so much over the last year? You get those answers to those questions, Ford could be a great one to hold on to, especially with that, what I said, that dividend was 5%, I think said 5.1%. So, and also, too, what is Ford doing going forward? I know that they have, the EVs coming on, but how are they going to handle changes? We have so many changes over the next 5-10 years and in technology. How is Ford going to do that? So I think it's definitely worth looking at. So take a look at the deeper thing, and if you find what you like, continue to hold.
Hey, thank you very much. I'm really curious as to how the whole EV transition that they started several years ago and is continuing to go is going to affect the stock price in the future.
And I will say, too, that I don't believe down the road we're going to be 100% EV. I think down the road what you're going to see, you're going to have a certain percent of people driving EVs, certain people driving, internal combustion engines, and then other ones like biodiesel, maybe natural gas. So we won't have like we've had in the past where everybody drives a gas car or diesel car. I think down the road, probably 5-10 years, you'll see a mixture of 3 different type of vehicles that you can buy and that we'll see on the road. So you want to make sure that the automaker that you're dealing with has those options there. All righty?
I certainly agree with that. Thank you very much.
Okay, Dwayne, thanks for calling. Have a good one. Bye-bye.
You bet. Bye.
All right. That does open the phone line, 833-288-0973. That's 288-0973 with area code 833. Tracy, and again, we do have the phone lines open for tax questions as well. Let's talk about something that, we've got a lot of casinos here in San Diego. I mean, what is there, 4 or 5 different Indian casinos?
Oh, even with some of the little ones, there's one pretty much everywhere in the East counties.
And also, too, there's card rooms
yes.
as well. A lot of they're still in California, which I never understood what they were. How can they do these card rooms? But that's not part of the show today. But what is part of the show is gambling winnings and losses. I mean, you're going to these card rooms, you're going to these casinos. How is this taxed? I mean, do people just slide on the radar? What happens here?
Well, when you do gambling and you win over a certain amount, the casino is required to give you a tax form and report that to the government.
Oh, gosh.
Okay, so yeah, it's called a W-2G for gambling. You're supposed to report all your gambling winnings like it is all income. You're supposed to report all your income, whether it's reported to the government or not. Okay, so you do report your gambling winnings. And we see a lot of people bringing in the W-2G, so we have to report that, obviously, on the tax return. But you're also,
do you have a lot of people bring in the W-2G? Do you see that a lot?
As a percentage, it's probably about 10% of our clients.
Really?
But
I don't know anybody. I mean, I've heard people say they're winners, but I think a lot of times they tell you about when they won, but they don't tell you the losers when they lost.
I see their losses. There's virtually no winners. Seriously, there's no winners. So, but yeah, the way the tax code has us deal with that is kind of different. So a lot of times in a business, we have income to report on our business schedule, and then we deduct our deductions, and then we pay tax on the net profit if we have a profit. Gambling is treated differently. We are allowed to write off gambling losses. So, but what we do is they're reported in 2 separate parts of the tax return. So the gambling winnings go on directly onto the 1040, and so that's what we report. And whether you got the government document, the W-2G, or not, you're still supposed to report all winnings. Right? Now we're allowed to deduct gambling losses up to the extent of our winnings. But where do we deduct that loss? Well, we deduct that on the Schedule A. So the Schedule A is itemized deductions. So that's why we write off deductible medical expenses, our property and state income tax, our mortgage interest. That's the Schedule A. So there's miscellaneous itemized deductions not subject to a 2% AGI limitation. I know it's getting a little wonky, but anyway, you deduct it on the Schedule A, but the problem is what if I don't have enough deductions and I don't file the Schedule A?
Yes.
Well, again, depending upon how big your losses are, you may not be able to take the benefit of writing off the tax losses. So for an example, let's say I have $10,000 worth of winnings. I've got to report that. I can take gambling losses, assuming I can prove I lost $10,000, but I don't. Even with that $10,000, I don't have enough to itemize. You just paid tax on $10,000 of gambling income, and you weren't able to recognize the loss on your gambling losses. And I see this quite a bit.
Wow.
The other thing, too, that makes the problem even a little more complicated is when we report those gambling winnings, retired people have their Social Security income. And let's say they're lower income folks, and so all of their Social Security income is not taxable. Well, what happens now if I come in with gambling winnings of $20,000? So even if I can write off the $20,000 of gambling losses and I don't pay tax on my $20,000 gambling winnings, that increased my adjusted gross income, and now half of my Social Security tax is now taxable, where it never was taxable before. Right. So you not only not walk away with any winnings, you're paying more tax because the gambling income increased your overall income.
And does gambling include lottery? If you won something,
all winnings.
All winnings.
All
so
winnings,
all-winnings.
Yeah. All games of chance
all games
are considered
chance.
gambling.
Wow.
And so for those people that do gambling fairly seriously and you're going to want to write off your gambling losses, the record-keeping requirement is very stringent. It's very strict. Mm-hmm. And so I would advise you to go to the IRS website at irs.gov. and just type in gambling losses record keeping, and they have a publication, and they detail everything that you need to do. And it's just not, hey, I'll just take the casino's report. A lot of times that's not going to suffice.
Really? Gosh,
Yes.
yeah. They make it so complicated.
They do,
so hard.
absolutely.
Gosh darn it.
And we've dealt with this in business with auto miles and auto logs and all of that for years. So just be aware of that out there, that the gambling winnings, while you may have losses, some people may not be able to use it. Other people actually may increase their taxes,
Right.
even if you can write off the winnings against losses. So just understand the dynamic. And this is where we talk about planning. And this is what I do with my clients when they come in and I have a situation like that. I say, look what this did. I mean, I'm sure you had fun, but you paid $4,000 in more taxes and you didn't win a dime.
And it could have also increased what you're going to pay in Social Security, you said, too, because they could bump you up there as well.
Exactly. That's where your income tax gets increased, because your potential Social Security taxable income from that could be higher than normal because of the additional income.
I'm going to ask this question. I ask you questions, you say, no, Brent, can't do that. So you're going to these casinos. You're winning money.
Mm-hmm.
Can you deduct your travel expenses?
No. Again, this is not a business. Yeah.
Thought I'd ask.
Yeah. No. And a lot of people ask that, and they say, well, you know what? I actually want to be a professional gambler.
Yeah.
No, you don't.
Really?
So,
Why?
yeah, it's extremely difficult to qualify as a professional gambler. Again, the IRS has rules and regulations for that. And the main reasons people want to write off it as a business.
Right.
So they can write off their losses. And they also want to then, take off traveling to and from the casinos. And
Right.
I go to Vegas. I want to write off the trip. And it's extremely complicated. And the IRS is really not willing to look at anybody as a professional gambler. Won't say that you can't ever qualify for it. But again, the hurdles that you have to go through to get recognized in that. And there's still going to be limitations.
And I was going to say, too, and probably it's going to trigger an audit.
Again, the IRS has their filters that they run everybody's tax return through, and I'm sure that's one of them out there because they have business activity codes that you put on every business schedule. So, yeah, it's probably going to cause you an awful lot more heartache than what you might think you're benefiting from it. So I advise my people, you're not a professional gambler unless you're at the casino, 12 hours a day, 5 days a week, like a job.
Yeah, like a job. Yeah. And then where's the fun in that?
Well, exactly.
Yeah,
That becomes a job. So.
Right. Yeah, so it becomes a job.
So we stay away from professional gamblers for the most part.
And there's probably a certain point to where maybe, I don't know, August, September, people get to a certain point like, you know what, you should probably stop playing, because if you keep on going, you're going to have now a tax situation to deal with. And so is there a number like that? People should say, you're at, I don't know, $4,000.
Well, again, it's going to vary for each person. So, but for the most part, people do it for recreation. Unfortunately, it's just like anything else that we come through in our life. There's an addiction that gets associated also with gambling. And I've worked with a few people at that where they have W-2Gs of $892,000. But they lost all that and another $500,000. So you just have to always be mindful of that too. Is it stopping being recreation and getting to be more of a personal issue with gambling? So again, I'm not a doctor. I'm just the tax doctor. But there are some things associated with gambling winnings and losses. And if you're doing it on a consistent basis, just talk to your tax accountant and find out what the rules are. So you're playing by the rules so you can take advantage of the law as it best benefits you.
Great. Well, let's go back to the phones. We got a call from John in Coronado. John, you're on the Smart Invest Show, Brent Chase. How can we help you?
Yeah, hi. I wanted to ask about, I do Roth conversions religiously every year, and the thing I have with Roth conversions is that it just keeps bumping up my taxable income. Is there any way, around that, or another way to account for it?
That's a great question, Tracy.
Yeah, unfortunately, no. Doing the Roth conversion, the whole point is to take it out of a tax-sheltered account, your IRA or some kind of retirement plan, and move it into your Roth account, and that's a taxable event, and there's no way of getting around paying the taxes. Have you sat down with your tax accountant to take a look at whether or not that makes economic sense for you? I've got some clients, Brent, that are in their 80s still doing Roth conversions, and they're not going to see the tax benefit in their lifetime because they're prepaying a tax now.
And probably sometimes you just do things because you've done them, but maybe it doesn't make any sense any longer to do it. Is that what you're saying?
Well, and that's what I'm talking to John about is just take a look and run the numbers and talk with your tax accountant and your financial advisor and just see fundamentally if it's doing for you what you believe it's doing for you. So, again, Roth conversions are great in a lot of situations, but maybe they're not for everybody. So I would talk to your two professionals, have them get together so that you fully understand. Knowledge is everything, John, and what you're looking for is some information and knowledge. You're a smart guy. You can go ahead and figure out the results once you get the information. So I would take a look at it with your accountants because, again, you're prepaying tax. I don't know anything about your tax brackets, but if you're in a 24% tax bracket and higher, and you might be in a 12% tax bracket without the Roth conversions, they got to show you the benefit and how long it's going to take for you to recoup that tax by having that money in a growth account that will be no taxes to pay somewhere down the road. So always take a look at the results, analyze it, and then you can make your own decision once you have the information.
Does that help out, John?
Yep, thanks.
You're welcome.
All right. Thank you. All right. That does it on the phone line, 833-288-0973. That's 833-288-0973. Talking with Tracy Gaines, president of Gaines and Wells Financial Services. Got a question, give him a call. Tracy, this is one thing that you might almost have to do every year. And as I kind of said when talking to John, I think sometimes people just, I'm just going to do this every year. But things can change, and you got to check things every year because things change.
And especially in our business, change is ever present in the tax code.
Yeah.
That's why we have education requirements, which I would be going anyway. But for my EA designation, I've got to take a minimum of 22 hours a year. I take 40-plus hours
to keep
a
up
year
on what's
to
going
keep
on.
up on the
Right.
changes, refresh my memory about old law that
Right.
sometimes maybe we need to refresh our memory a little bit about some things. And so education is important. And you're right. The tax law changes. People's lives change, Brent, from this. And, kids grow up and now they're not a dependent on your return anymore. How's that going to affect my results? I had a college child. I got the deduction or the credit for the child plus some education tax credits. That's now gone. So, things in your day-to-day life may seem the same, but year-to-year things do change. And
Right.
so especially when you get into other things like divorce and who's going to be claiming the children on various tax returns. So again, I just encourage people to engage their tax accountant. Our clients in our office, Brent, we encourage them to call us. We don't charge for phone calls. If you do have to come in and we do have to do an analysis or work, of course, we bill for our time for that. But I encourage my clients and anybody listening to call, ask the questions, get the right information so you can make an intelligent decision.
And many times, and again, I've worked with you for years, many times just a quick question and a quick answer.
Change your whole perspective.
Yeah. And if it is more complex, then you say, well, we got to look into this deeper. But sometimes it's just, it can point in the right direction, save me, anybody, your clients, thousands of dollars in taxes because you made one 1-minute phone call and you just said yes or no and took care of it. I mean, and that's why I've worked with you for so many years and refer my clients to you because you're very good on that. Not saying, and it's funny, I just talked to a client whom I may have called you. I actually told her to call the show because they had this major tax bill from their tax person. They did first year with them, and he won't return the phone calls on why it's so big. And it's just like, I said, that's wrong.
That's beyond frustrating.
Yes. And you go, we've called him multiple times, and he just ignores the phone calls.
Yeah.
I said, well, you got to switch over to Tracy because Tracy does call back.
And just like you, Brett, we're a client-based business.
Yeah.
Our clients are our business. And so, again, I know of other accountants that they don't return phone calls for a week or two. We return phone calls same day if we can, or certainly within 24 hours, except if we're extremely busy. And I encourage my clients to call. Okay, so you really need to have that open line of communication with a tax professional that's knowledgeable and that gives you the kind of service that you're looking for.
Right.
So that's extremely important.
And you may not have the answer right when they call in if it's a complex situation.
Exactly.
But still, you return the phone call and say, well, let me look into it. I'll get back to you tomorrow or the next day. And don't call on April 15th expecting you to pick up the phone.
You'll get a busy signal.
yeah. So, but reasonable, again, and I talked to her, I think it was Wednesday. And I said, well, the tax deadline is coming up October 16th, so they could be busy, but someone should still be giving you a call back on that. And to my knowledge, they've not called it back. And that's
to me, there's no reason to not. I mean, would you not return your clients' phone calls?
No.
I mean, it's just good business practices. And again, everybody has a right to run the business the way that they want, but client communication is at a premium for me. So,
and I do tell people, do not email me because I get 100 emails a day. So if a client emails me, it's possible I'll miss that email because with 100 emails a day, it's possible it just got pushed down to the bottom. But phone calls, I probably get, I'll say maybe 5 phone calls a day. So if you call me, you'll get the return phone call. Sometimes the old technology works of talking to people.
Hey, we're both old school. I hate to say that, but I'm still a paper guy a lot of times. So, but client service is everything. So, returning calls to clients, listening is so key in both of our businesses to what our clients are going through, what's their particular situation and what's concerning them, and actually getting to the basis of what it is that they're looking for. Right. So, again, we'd be more happy to help people. We can't tell about the middle of November.
Again, the phone number.
Yeah, so give us a call.
When they call you, you will call back.
Yeah, absolutely. Yeah. Our office is
there.
going to be shut down for 2 weeks after the 16th for remodeling. So I would say if you want to get in touch with us, email us at gainesandwelch.com or give us a call at 619-282-8290. But again, call us after, say, November the 10th, and we'll get right back with you. More than happy to help you, answer your questions, and get you hopefully pointed in the right direction. Funny thing, talking about the same thing, and I've gone through this my entire career, is I talk to especially a new client, and I come up with something, I explain the law to him, and goes, well, I talked to my neighbor, and his brother-in-law used to be a CPA 32 years ago, and this is the way it is. And it's so people take tax advice from anybody, and they go with it. That's the law, and man, it's more times than not, it's not anywhere close to what the law really is.
And you mentioned how people still say, well, how long do I have to roll over that amount? I mean, they're basing on old laws, and you said they change every year, and that's why you spend 40 hours a year plus keeping up on what's going on because it's changing. Right. And if you can't do your taxes based on
the average person can't keep up
No.
with the changes, and of course they don't know the law to the extent that we do. So
again,
we're not for everybody. I mean, if you have a pretty simple return and you just have a W-2 and you're still renting right now and you're reasonably sharp and you don't have like kid issues and daycare and other complex things that make the return more difficult, I have nothing against TurboTax and those kinds of things, but software only does what you tell it to do.
Right.
And so if you're not sophisticated enough in to understand the tax law or how to put the information into the software, you're not going to get the correct answer.
Yeah. No, you got to know what to put in.
Exactly. And you have to know the law. Again, sometimes, a lot of times we can move information around to get a better result. You need to know what those options are.
Yeah. And I got an important question. I know that we do have a call from Joanna La Mesa and David in Long Beach. I'd like to have you call back next week because I want to answer those for you, but I want to finish up on the tax side here because there's something that affects a lot of people here in California. And what I'm talking about is a married filing joint versus married filing separate. I mean, I'm one of because I'm not a tax person. I remember before, it doesn't make any difference. Well, I don't think that's the case any longer because things change. Why don't you explain what you're talking about there?
Okay, so tax law is governed by the laws of each state that you're in. Okay, so for California, we're referred to as a community property state, which husband and spouse, everything acquired during their marriage is owned 50-50. Doesn't matter who made it, who earned it, whose name's on it, doesn't matter. It's 50-50. And most of the other states are what are called common law states. Your wages would be your income. Your wife's wages would be her income. And so in the tax code, we have to follow the law according to our state law. So in California, we're a community property state. So it's almost never better to do married filing separate because what we are required to do is take all the income of the entire family, doesn't matter who it comes from, split it in half. So you would report half of all the family income. Your spouse would report half of all the family income. You split all the deductions. And so the married filing separate tax rates are typically worse than the married filing joint. Plus, you have phase-outs of credits, you have phase-outs of deductions. And so, again, in California, married filing separate is not going to work. Okay,
Right.
they just don't let you. You can even have separate bank accounts, but what comes down to the law, if everything was acquired post-marriage, it's all community property. In common law states, they do have that opportunity because you have his income, his assets, her assets, and so you can kind of play that game, married filing joint versus married filing separate.
Right.
So that is something that you could do, in Maryland or some of the other common law states, but in California, it just doesn't work.
And actually, that I got married in July, so after being
Right.
single for 12, 13 years, I'll come in on
Married
April.
filing joint this year.
Yeah,
Brand new territory.
Right, brand new territory.
Exactly.
So, and it's so important because again, obviously, there's a big difference between my income and my wife's income, but it doesn't matter because California. Now, what about somebody that does have a residence somewhere else and they maybe have a residence in a state that is not community property?
Yeah, that's a really good question, Brent. And it goes by your state of residence. So this is kind of like, where do I live?
Right.
And again, your tax home can actually be different than your employment home. So especially for people that live on a border of a state. All right. So let's say you live in a city right on the border and you work across the border. So your tax home is where you make your money. Physically, I'm
Right.
in the state of Arizona. So Arizona's going to want to tax my wages because that's where I physically worked. But I live in California. So I am a resident of California, and I have to file a California tax return. And so immediately people are going to say, well, that's not fair. Double taxation, we can't do that. And they're right. So the way we handle that in given situations is we calculate the tax on where the tax needs to be paid. And so this would happen a lot of times for people that have rental properties out of state. I live in California, but I've got a rental property in Maryland.
A lot of people are doing that now,
Yeah. And so, especially with people getting properties out of state.
Yeah.
So you do have to file a Maryland tax return for your rental activity, okay, and deal with the tax consequences there. And let's just say there is a tax in Maryland. As a California resident, you're taxed on your worldwide income, just like at the federal level. Doesn't matter where you live, you're taxed on your worldwide income. Well, if California's taxing me, why do I have to pay tax to Maryland on the same income? What happens is California will give you a tax credit against the tax that you paid to Maryland. Sometimes it's not 100%, but a lot of times it is.
It's close.
So if I paid $1,000 in Maryland income taxes, I would take a credit against my California taxes for that same $1,000 to avoid the double taxation. But I get a lot of people retire and say, well, I'm moving out of California. It's a too high tax state. And so, again, you have to understand what the rules are to qualify to be a resident of a different state. And you physically have to live there. You can't play these games. Hey, I got a post office box. No, it's not going to work.
And we've got about a minute left here. I do have clients that have rentals out of state. And I just thought when you were speaking, well, you may miss the benefit of a rental property in Texas or Maryland, whatever, of the depreciation they get to write off against your taxes because you can't do that if it's in another state on California tax?
No, the federal law applies to everybody.
Federal law,
so,
but the
yes,
state
laws, again, each state law is going to be different. But when it comes to rental properties or basic items like that, the laws are pretty much the same.
I mean, the state of California now, our taxes are so high. It's I remember it used to be just a few dollars. Now it's not much less than the federal appears to be.
But for most taxpayers,
right.
We get into the state rate is 9.3%, which is a very wide bracket.
Right.
We do get into the 11s, 12s, 13%, but that's really high income. People over $1 million of income are going to see the extra high rate. Right. But even 9.3 is a high rate. Hey, Brent, thanks for having me on today. I really appreciate it, buddy.
You're welcome. There's the closing bell. If you want to contact Tracy, give him a call at his office, 619-282-8290. That's 619-282-8290. Thanks for listening to Smart Investing Show. It is for informational purposes only. Should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. Also, you can call. We'll give you Tracy's contact information as well. And visit our website, smartinvesting2000.com. That's smartinvesting2000.com. Thanks for listening to the Smart Investing Show. We'll be here next week on the Smart Investing Show.